welcome back to Happy Half Hour May's edition. That's Toby Weber. I'm Nik Schuurmans. No shortage of things to talk about. We had a ravenous AI rally, the Great Rotation, seemingly dead, apparently. Now it's AI and everything else. The war still rages on, although we're in the middle of a ceasefire. Oil prices still structurally high. We've had some really savvy hedge fund managers lately come out and say, this is an everything bubble. That fervor, that message is starting to become more mainstream, yet stock prices keep going up and to the right.
Yeah, so let's start there. What do you make of that? Is this an AI rally that's going to continue for months and months and years, or is this getting a little bit ahead of itself from your perspective?
So let's look at this through the lens of history. And I know, an AI company in 2026 is tougher to value than an automaker in 1950. But here's some truth here. So the average length of a bull market, so a bull market is up at least 20%.
Okay.
Since 1931, is 1,022 days, so roughly 3 years, give or take.
Okay.
With an average gain of 114%.
Okay.
Okay. Where we're currently at, from 1022 through yesterday's close, we're up 106%. So about the same as historical average of a bull market.
Sure.
Pretty close. But we're going on 1,300 days. So what that means is, from a appreciation standpoint, very consistent with the average bull market since 1931. This one has gone on a little bit longer, almost a year longer than the average. I don't know what that tells us. It might say we're a little long in the tooth, but when you look at the rise, it hasn't been as parabolic as maybe some other bull markets.
Mm-hmm.
Any feedback based on those stats?
Yeah, based on that, it sounds like we're not too far afield, but we've also seen the drop that we had in March because of the Middle East conflict, and then the recovery in April was one of the fastest and most significant recoveries we've seen in the last 40 or 50 years. So, and that's not because the war has been resolved. Yes, we're in a ceasefire, but I think it's a function of the AI narrative and the earnings. There are actual earnings associated with this. Earnings estimates are up, double digits this year. So I think that's just kind of overridden. People are looking through the conflict in Iran and focusing more on the longer term and the benefits that this AI story may have. Do you agree with that, or needs to play out?
No, markets care about earnings. Look, as we talked about last month about this, that markets move on from geopolitical headlines rather quickly, and now we're focused on earnings. So there's a bit of a Johnny-come-lately as it relates to the news cycle. But to your point on earnings, most S&P 500 companies have reported 74% have beat on the bottom line, earnings per share. The 10-year average for beats is 67%. So we're almost 10% greater than the 10-year average for earnings per share beats. So for those that don't know what a beat is, Wall Street analysts come out with expectations for earnings for each company. And if you beat, that means you exceed that estimate. And if you fail to beat, or if you miss, that means you're below that estimate. So more companies are beating earnings per share relative to the 10-year average. Okay, so that's a tailwind for stock prices. On the top line, the revenue, the sales side, which is much harder to gamify, meaning you can't really smooth out a revenue number. So a lot of investors like that. Again, 74% have beat relative to the 10-year average of 65%. So better earnings on the top line, sales and revenue, better earnings on the bottom line, earnings per share, which is why you've seen, and it's even better for some of these big hyperscalers, the big tech companies. They've really posted some just mind-boggling numbers to the upside.
Yeah, the lion's share of the earnings growth this year in the S&P 500 is coming from the technology sector and from the energy sector, which makes sense if you think about it. But that's, I think, what people are pinning their hopes on with this rally, is that the earnings growth is there. And as you pointed out, it's coming to fruition. So perhaps we're not getting too far out over our skis.
Now, what's concerning for some folks, and we'll talk about some of the hedge fund managers that have come out and are kind of sounding the alarms, is this rally is fueled by the AI names, the AI complex. When you look at breadth, what the other, call it 470 S&P 500 companies are doing, it leaves a lot to be desired. So this is a very top-heavy rally. The concentration in the S&P 500 index is somewhere around 41% or 40%. And there is a growing gap between what's worked and what has not worked. And a lot of this is being fueled by a basket of companies.
And you've seen some remarkable moves just since March 30th. So Intel, old warhorse. I mean, I think we thought Intel was left for dead. Intel stock was trading at $40 a share at the end of March. It's $125 a share today. Micron in the memory space, trading $300-400 a share. Now we're pushing $800 a share just in the last 5 to 6 weeks. So we've seen some pretty remarkable and narrow moves, to your point.
I have another context stat. So the recent AI rally, the NASDAQ is up 650% in the past 10 years. That's a 6x. Okay. That's crested the Japan rally in the 1980s. It's exceeded the S&P rally in the 50s and the Dow Jones rally in the 20s. Hasn't quite eclipsed the tech bubble from 99 and 2000 as far as appreciation, but it's second place when you look at some of these all-time bull market rallies throughout the world.
So you're great at throwing out stats, but what do you think this means? What should investors be focused on? You know what I mean? Hey, just stay the course and we're going to ride this thing higher. Should we be concerned? Should we, how do you interpret all of this great information that you've provided?
Great at throwing out stats sounds like an insult, but I'll push that aside.
Okay.
So I recently wrote a blog post and I got some feedback from clients on it. Starting point matters, meaning investors would do well to accept the next 10 years might not look like the last 10 years. What leads seldom leads every single cycle. And what concerns me, that doesn't mean I'm bearish. Certainly there's money to be made in AI. And like I've said in the past, like we own the AI names. We want to own US large cap. It's been a great place to be. The pause that I would like to interject is I'm seeing more retirees invest like they're 25 years old, where they're not thinking about risk management. They're living off of their portfolio, and 99% of the conversations they have around their portfolio are based on performance. That usually doesn't end well. And then you throw in the fact that a lot of them are crowding into technology. Again, I'm going to sound like a broken record, but we see a lot of prospective client portfolios, and without fail, these portfolios are massively over allocated to tech. And again, in investing, it's important to identify the game that you're playing. Most retirees have stuck their flag in the ground. I'm done working. This is my enough. I want to travel. I want to spend time with my family. And then you look at their portfolio and they have 70% in NASDAQ, and then they own the Mag 7 companies outright, and they're shoveling money into the hyperscalers and the memory stocks and the infrastructure stocks. It's like the range of outcomes is super wide, and you're investing to maximize the pain of regret. Meaning, as we get a correction, which is inevitably going to come, you're introducing 40-50% downside for a portfolio that you need to sustain your lifestyle. It just doesn't make any sense.
Yeah, and it's easy to see why they would do that, because it's worked.
Yeah.
And pretty much since 2009, buying the dip and buying those names, you just have to hang on, sometimes not for very long, and you're rewarded. And so if you do something and it works, and you do it again and it works, you're going to keep doing that until it doesn't work. It's kind of like touching the hot stove. And that's, quite frankly, one of the things that keeps me up at night is at some point, the buy the dip strategy is not going to work. And yet people are going to continue to do the things that they've done, thinking that it will eventually work. And that's where people can get themselves in trouble, especially retirees that may not have the wherewithal to withstand a 20, 30, 40% hit.
Yeah, and we recently just saw this where, again, a lot of folks were positioned aggressively coming into the war. The Mag 7, the AI names really sold off 30, 40%. And you had a lot of folks that were positioned aggressively looking to get out of the way. And that's not good investing, where you take a bunch of risk, market correction happens, and then you try to sell and then get back in when it's back. It doesn't work that way. That's how to be miserable. That's how to end up with egg on your face. Because as we've seen, a lot of these rallies don't wait and see. And what I mean by that, they don't wait and see that the war ends. They don't wait and see for the event to be more clear. Markets don't have a sign that says flashing green, there's nothing to see here. Go ahead and take a boatload of risk and print money uninterrupted. Investing doesn't work like that. So again, for retirees, you really need to be mindful of your risk exposures, your position sizing. Don't invest like you're 25. Know the game that you're playing and adjust accordingly.
Okay, good advice. I've got a question for you. It's a multiple choice question.
Multiple choice.
Yes.
Back to my CFA days.
Yes, related to the Middle East conflict.
Oh.
Since you're a geopolitical expert in some circles, is the impact of the conflict in Iran behind us? Is there a potential that it's still in front of us? Meaning oil supplies dwindling, oil prices climbing, or is it somewhere in the middle that we're just going to kind of muddle through this and come out the other side?
I didn't hear any multiple choice answers, but this is what I'll say, and I've been pretty consistent in this. Well, there's the impact on the economy, and then there's the stock market. I think a lot of people mix the two, and they're completely different. The stock market has completely moved on. The stock market, I don't want to say doesn't care.
Sure.
But it's basically moved on.
It's looking past it.
Now, the economy, which affects our peers, our friends, our families, ourselves, the longer this goes on, the more it's going to show up in consumer prices at the pump and the goods that we consume every day. And I think we're getting to that point where it's going to be structurally harder and take longer to reverse some of the, I don't want to say parabolic, but upward movement in oil and energy and gas prices.
Yeah, I think that's fair. The longer this continues, it's not a positive. And the impacts that we've seen have already started to show up in the CPI, the Consumer Price Index, and will continue to do so. And potentially that not only has an impact on the economy, but also has an impact on the Fed and what they look to do this year with Kevin Warsh coming in. Is he going to be able to cut rates or no? Because of the inflation, he's going to have to sit tight or potentially even raise rates. So it brings some uncertainty into the mix, to be sure. And it's just difficult to know how it plays out from here.
Well, and the flip side is we're less dependent on oil than we've probably ever been. More people work from home. People drive EVs, they drive hybrids, and our behaviors are different than those in the 50s. So we're not as dependent, but certainly, we're still like it's kind of comical. Before the war broke out, everyone talked about tech and AI, but we're still very much dependent on some of these old school railroads and industrials and materials and oil and energy. That still very much matters, but it matters less than it did, say, in the 1960s.
No, I think that's fair. What are you hearing from clients these days? What's on their mind? Anything you feel like would be helpful to share?
How do I word this and not get myself in trouble? But people, their mindsets are very much tuned into the news cycle and what price is doing in markets. When price is down, people feel bad. When something breaks out, it could be a war, it could be a recession, it could be a tariff tantrum, they get wrapped up in the news cycle, and that reflects how they're feeling. When markets are up, when things are good, I get a lot of like, how can we maximize performance? How can we increase equities? And then when we get an episode like we did in March, it's like, oh, I don't want to lose money. Let's think about being conservative. So I always say price drives sentiment. And nothing is more true than the last few months, where price really drives sentiment. Investors don't manage risk, they manage narratives. And fortunately or unfortunately, it's really easy to do that with cell phones and computers and instant information.
Yeah, I think it's one of the reasons people rely on us and people hire us is to help them tune out that noise and not make knee-jerk decisions that are going to, negatively affect their financial future. So, in some respects, it's when we earn our money. But I would agree, when the market's up, people want to know how they can maximize that and capture more of that upside. And when the market's down, how do we get out of harm's way? And that's a difficult balance. And so you're trying to come up with a risk-appropriate investment allocation, something that you can stick through in good times and in bad.
Well, and that's a big motivation to why I write and why we do these podcasts. There's so much information out there. Humans cannot process all of it. And if you consume everything, then you consume nothing. So we really try to provide an objective voice that doesn't rely on a crystal ball. We're not making predictions. We don't have hot takes. We're just trying to look through the lens of what's worked, empirical evidence, history. My investing temperament and my emotional makeup as an investor has improved so much just by reading history and diving into history and shunning the news cycle, shunning forecasts. It just makes for a much more peaceful approach to asset allocation and the way I think about markets.
No, that's well said. You have a question for me, or otherwise I've got another one for you?
I've got some questions for you.
Okay.
So as our resident market bear, glass half empty as you like to say, and you like to say I'm an optimist, I'm not, I'm a realist. But so now I'm taking jabs at you.
Yeah, it's really.
Okay.
That was nice opening.
So what do you make of some of these well-respected hedge fund managers? Paul Tudor Jones, Warren Buffett, Burry recently has come out and said, sell everything that's had a massive rise because we're basically in the tech bubble. What do you make when you hear some of these proclamations?
Yeah, I think these are people that are well respected. These are people that have been in the markets for decades. So I think you have to give them, a little bit of rope and understand where they're coming from. They're really looking at fundamentals, and it's interesting. Paul Tudor Jones came out and said he was concerned, and then 2 weeks later he said he was buying AI stocks. So I think these people are doing the best they can, but I think they're looking at the fundamentals and thinking this likely can't continue. You don't hear people saying a bubble, but Buffett was pretty candid with his comments at the Berkshire Hathaway meeting that there's a lot of gambling going on as opposed to a lot of investing. So I take it with a grain of salt. If it was just some random person, maybe you'd disregard it. But I think their reputation and their history makes it worth listening to. I just wouldn't take any action based on that information. How do you interpret it?
I think that's fair, and I do pay attention. However, a lot of these folks, like Buffett's been sitting on cash for a long time,
Sure.
which means he's missed out on a rally, and Tudor Jones has been talking like this since 2022. So you think about some of these decisions sitting in cash, they're not free. There's an opportunity cost. And then back to my earlier comment, I think this is just a much different regime for when these folks came up, right? They went from valuing a company that made widgets or cars to valuing a technology, AI, intellectual property. It's just much harder to value a company. And I wrote a piece how every historical measure is saying US markets are stretched. Well, they've been like that for 7-8 years. And if you were to just go by starting point or how stretched something is, you likely would have missed out on a large rally. However, over the longer term, I think these smart investors are right. That starting point does matter when you look at over the next 10 years. It's really fleeting in the short run. Something that's overvalued can stay that way. Something that's cheap can stay that way over 1, 2, 3, 4 years. But I think as an asset allocator, I think the mistake that folks make is thinking what's worked over the past 10 years is going to be the same playbook that works over the next 10.
Well, and these people, like in Buffett's case, they're either managing their own money or they've been doing it so long and been so successful that it's not like they're going to get fired per se. So I think that's one thing. And two, just because they make that statement in an interview
Right.
doesn't mean that they're adjusting their portfolio and getting completely out of stocks. I think some people think it's a binary result. If they talk negatively of the market, it means they're 0% in stocks,
Right.
and that's not going to be the case. So I think you take it with a large grain of salt, and to your point, look at the source and don't overreact to it.
Yeah, people talk a lot about Buffett and his 400 billion cash hoard. Well, he still has trillions in market exposure.
Correct.
He's still relatively fully invested when you look at his balance sheet.
Correct. And if he underperforms for a year or two or three, it's not going to be the end of the world. He's trying to position, I assume, for the next market pullback and being in a position to take advantage of that, which will lead to outperformance in the future. Now, does it work? We'll see. But historically, he's got a reputation you'd give him the benefit of the doubt.
I've got a question for you.
Okay.
Think about your happiest clients. The happiest clients in which you work with.
Yep.
What are some characteristics of your happiest clients?
Happiest generally in terms of life?
Yeah, just life, their attitude towards markets.
And maybe this is where you're headed, but it's the ones that aren't really paying attention to the day-to-day financial. I'll have clients that say, hey, that's what I pay you for. I'll open it up once a month, once a quarter, and I'm typically surprised that it's higher than it was last time. But the people that aren't following the investments in the markets and the news cycle so closely seem to be the ones that are out enjoying their retirement, enjoying life, and not fretting or worrying about the minutia of the day to day.
Yeah, some of the smartest things I hear from clients is, and folks say this in a sheepish manner, but I think it's very, very astute and intelligent. Oh, Nick, I don't even look. I don't even pay attention. Yeah. And my response to that is, I've heard of many, many worse strategies.
No, that's the biggest compliment I think they can give us. Clients can give us when they say, I don't need to look at it. I don't need to worry about it because I know you are and that you're on top of it and doing a good job with it. I don't think there's a better compliment that we can get.
And then on the other side, I think the folks that, I don't want to say are miserable, but are focused on markets, the news cycle, they're clicking buttons on their phone, they're going down rabbit holes. It's like when I zoom out and think about my last days in the blood, sweat, and tears that went into building a nest egg, I'm not going to be sitting in front of a computer in my pajamas clicking buttons at 2 p.m. when it's 75 outside. I'm going to be full sending it, playing golf, going to my grandkids' soccer game and basketball games and spending time with my nearest and dearest. Those are the happiest clients to me that can fully zoom out and appreciate they're playing the long game. They've built a portfolio that reflects the way they feel about risk. They've hired a team to manage and steward their wealth, and they're going to go enjoy all the things that really make life meaningful.
Well, and history has shown that fretting, worrying, monitoring on a daily basis doesn't help your returns. In fact, it typically hurts them because you can make bad decisions or miss your timing in terms of making changes in the portfolio. I always get a kick out of the best performing portfolio. Someone did a study at a particular custodian. The best performing portfolios are the ones where the person lost their login or they passed away. Therefore, they're not looking at it, they're not making changes, they're not worrying about it. Those were the best performing portfolios in the entire group. So I always think that's a funny.
So the best performing accounts are from dead people?
Pretty much, because they couldn't make any changes. They just let it ride. So maybe there's some lessons in there. Last question I have for you is, and we were talking about it before we flipped the record button, but talk about some of the prospects and statements that you're seeing, and because we just continue to be amazed at some of the stuff that other advisors are doing. We're not trying to disparage, others in the industry, but maybe their best interests of the client are not always first and foremost.
Again, how can I say this nicely? One, I came up in a big Wall Street firm, and I fully understand the misaligned incentives and the conflicts of interest, and 90% of internal conversations when you work with a big Wall Street firm that run commercials all day is sales. How can I bring in business? How can I monetize what I currently have? If you read the research notes and the earnings notes and the footnotes of these big Wall Street banks and brokerages, they openly discuss how they're monetizing and working against and cross-selling clients. If you look at the most fined firms year over year, they're all the big Wall Street firms, all the big Wall Street banks. I'm amazed that people still trust their capital to these firms. And to Toby's point, we've been swimming upstream. We've got a marketing funnel. So we see a lot of prospective client portfolios. And it just baffles me in 2026 how these advisors, these Wall Street advisors, stuff client portfolios with expensive mutual funds and non-liquid REITs and structured notes and private investments that cost 5% a year. They're not tax efficient. They're lighting money on fire to Uncle Sam every year. They fail every metric of Portfolio Management 101 and what works, yet people continue to allocate their capital. Folks, I can't say it enough. If you work with a Wall Street firm, that's not a friendly place for your capital. When you're mandated to maximize the bottom line, when you're a publicly traded company and you have to maximize the bottom line, that's what's going to drive your behavior. Client outcomes are an afterthought. Okay? So I can't say I can guarantee you, but 99 times out of 100, if we see a Wall Street firm statement, there are many, many things that we can do better. And it's rooted in common sense. It's like tax efficient investing beats not tax efficient investing. Low cost streamlined investing beats high cost illiquid investing. These are just common sense principles. And if you're going to be invested for 10, 20, 30 years, these decisions, these mistakes compound over time to be something meaningful. So I would encourage you, if you work with a big Wall Street firm, I'll stop in a minute, but it's worth your while to go out and just see what an independent RIA can do for you from a fee, from a cost, from a risk, from a tax standpoint, because we see it time and again. And it's like clockwork, where if we look at a statement and we see one of the big firms on there, it's littered with conflicts.
I just like to get you wound up. But honestly, it's the reason you started Pure 10 years ago is because you wanted to be transparent, you wanted to have low cost, you wanted to be more tax efficient. And yet here we are 10 years later, and we get statements on a weekly basis that, quite frankly, the clients would have a hard time explaining what they even own. Mm-hmm. And it's opaque. They can't see through to the fees. The fees are much more than they ever anticipated or ever knew. So it's just amazing to us as we see more and more of these. The behaviors aren't changing. And to your point, that's where I think we can help folks.
Well, and the last thing I'll say is, as we've seen over the past year, investing is hard. Stuff comes out of nowhere. So many prospects want to talk about performance and what the market does next and the war that broke out. These are all external factors that you can't control. In the investment process, there's a few things that you can control. What you pay for advice, tax efficiency, risk exposures, position sizing, your own behaviors, the financial planning process. It drives me nuts to see people focus on external factors and have so many internal things that they can control, the low-hanging fruit, just lighting money on fire. So turn the mirror towards you, focus on what you can control, give yourself a chance for a favorable outcome. That starts with a lot of those things that I just mentioned, not what some guy on TV talks about in his crystal ball and hot takes and forecasting and all that. So with that, coming up on a half hour, thanks for watching. This is going to be the featured post in Sunday Coffee Reads because we think there's some decent stuff in here and we want to showcase it. So give us feedback. We hope you enjoyed it. We'll see you in June.
Cheers.
Take care.